Feels exactly like 1999. I don't know whether we'll actually replay it exactly, but I think all the ingredients are in place. And certainly from a trading standpoint, you have to position yourself like it's October 99. I don't see why you would do anything but that. And remember, the NASDAQ doubled between the first week of October 99 and March of 2000. So if it looks like a duck and quacks like a duck, it's probably not a chicken, right?
That was Tudor Investment Corporation founder and CIO Paul Tudor Jones this morning on Squawk Box, saying today's market feels similar to just before the dot-com bubble burst, encouraging investors to position like it's 1999. Is he right? Well, joining us now is Citi Research Director of U.S. Equity Strategy, Drew Pettit, and Truist Wealth Chief Investment Officer, Keith Lerner. Keith, it's easier to say position yourself like it's October 1999 than it is, I think, to position yourself like it, even knowing what we know now, short of getting out of the market and then getting back in at some time later, market timing, which is unwise. How would you position yourself like it's October 1999?
Yeah, well, great to be with you. You know, the way we're thinking about things, John, is we've been overweight tech and communications most of this year. We're still overweight those areas. And maybe there are some similarities to the late 90s, but there's also some differences and some quantifiable differences. The first thing is that the technology sector as a whole, it is trading at a risk valuation around 30 times, but that compares to about 50 times back in the late 90s. Heading into the peak of March of 2000, the market was up, as kind of mentioned, on a year-over-year basis, over 100%. On a year-over-year basis right now, the technology sector is up about 28%. And the other thing that's somewhat different in our view, and at least in our work, is that the earnings momentum today is a lot stronger than what we saw back then. So we put that all together. Yes, that's risk, but is it the same period as the 90s? Maybe the infrastructure build and all the spending that we've been talking about is moving that way. But from a quantitative, fundamental, and technical view, we're just not there yet. And we still think this bull market has longer to go.
Drew, let me try this with you. Even if it's not exactly the same, if perhaps we are in a sort of a bubble, how would you learn from October of 99 and position yourself right now?
Pair your beta. That's what we're saying to clients right now. So yes, the NASDAQ, to Keith's point, has really good earnings momentum, and we like that story. We believe in that secular story, and our team doing work on AI is just raising its infrastructure investment estimates. So we believe that story. But to your point, what do? Pair my beta with some cyclical beta. We're not chasing low beta, low volatility stocks right now in defensives. Instead, we'd rather add some small caps here, some cyclicals where we might have inflections, where the embedded earning expectations are really low. What a lot of people might not remember, the next growth area out of the market after the tech bubble popped was, well, financials and cyclicals. And guess what we're pairing a tech overweight with? Financials right now, in financials and small cap.
Keith, what do you think of that approach?
Yeah, we actually did upgrade our review of small caps back in August. Now, they've been cheap and underloved for some time. The difference more recently is earnings are moving up. And there is certainly concentration risk. And if you have a little bit of money that moves out of these large cap names, a little bit of outflow and inflows into small caps can go a long way. So I like the idea of at least hedging some of your risk with small caps. And also, if you think more globally, we're more neutral international. But look today, I mean, Japan's making more than a 40-year high. The EFI, or the developed international markets, are breaking out to a new high. Emerging markets are working. So as much as we're focused on the U.S. and the strength here, we are actually seeing global participation. So we would have exposure beyond just tech, but within a portfolio, we still have a bias towards tech and growth because we still think this is an AI-dominant bull market. And we think that trend ultimately continues, even if there's some hiccups along the way.
Speaking of AI dominance, Drew, what do you think of this latest news today out of AMD and OpenAI? There have been talk about circular spending, but to me, this looks like a branch off of it. It's not, OpenAI to NVIDIA, NVIDIA to OpenAI. This is going to AMD, no?
Yeah, we've been seeing this in tech. This is why we like semiconductors in tech, right? When you get in these cyclical investment periods, and I know we're talking about AI as a secular story, but the ground floor is what we have to focus on right now, and that's building the infrastructure, and semis are part of that. And we're happy that's broadening, and we're happy to see that within semis, part of our bull case there. The other thing, too, just going back to Keith's point, AI is a global story. We forget about that as we talk about some of the big names and private companies in the U.S. But AI at a reasonable price, ex-U.S., is one of our favorite baskets right now. And that has surprisingly outperformed all the U.S. AI names off of the April lows.